Hello and welcome to another exciting session on time value of money. This session is meant to assist both those who are in business as well as those who are studying. So, for those who are in business, you definitely need to determine the net present value of your investment or your internal rate of return on your investment. So, after going through this session, you're expected to have obtained an understanding on the following: calculate the present value of mixed stream cash flows, calculate the net present value, as well as calculate the internal rate of return. So in terms of mixed stream cash flows, we are going to be able to apply that to a question here. So normally for mixed stream, you want to be able to determine the present value of cash flows that are not constant, right? So for instance here, Lerato is considering investing in a fund that will result in year earning the following annuities at the end of each year. So year one, 20,000; year two, 25,000; year three, 30,000; year four, 35,000. So what is the present value of the annuities today at a rate of return of 10%? So instead of calculating the present value of each investment individually, then sum up the answers that you get there, we are going to apply the cash flow function to it. Right, so our first step would definitely be to clear our memory because our calculator stores data from the previous calculations, so we don't want that to distort our calculations. So since Lerato is not going to receive an annuity in the today, only she's going to receive at the end of the year, our cash flow zero will be zero. So then the first cash flow that she's going to receive at the end of the year, which is 20,000, will be cash flow one. Then 25,000 will be cash flow two. Then 30,000 will be cash flow three. Then 35,000 will be cash flow four. Right. So after inputting this, we are then going to input the interest rate. Then we compute the net present value there. So it then means that the present value of all these cash flows here, they are equal to 85,287. So it means that these cash flows are just equal to a lump sum amount of 85,287.89 cents today. Then we come to the next one in our calculation, which is the net present value. So with regards to our net present value there is defined as the net present value involves the time value of money, and it involves estimating a project's future cash flows, discounting these cash flows at the company's required rate of return or cost of capital, and subtracting the cost of the investment from the present value of these cash flows. So if the result is positive, this indicates that the project results in an increase in the value of the firm as the project earns more than the cost of capital. So you will see in our question that we're going to do that the cash flows that are going to come in, we discount them minus the cost of investment. So our calculator does that for us. So we're going to apply that. So in our question here, Lerato wants to buy a wine making machine for a business costing $100,000 and will incur $5,000 on installation cost and 2,000 to transport the machine to the factory. She expects to generate the following cash flows from using the machine. So year one, 30,000; year two, 40,000; year three, 42,000; year four, 45,000, at a rate of return of 10%. Should she invest in this machine based on net present value? Right. So with regards to this, we are going to input this information into our calculator, and our first step is, like before, we need to clear our memory. Right. So after clearing our memory, we now look at the inputs there, that the cost of investment there of 107,000 will be the initial cost of investment, which will be our CF0, what's the cost that you incur today. Then 30,000 will be our cash flow 1. So we're going to punch in cash flow there. Then 40,000 will be our second cash flow. Then 42,000 is our third cash flow. Then 45,000 is our fourth cash flow there. Then we input our cost of capital or our rate of return there of 10%. Then we compute the NPV. So we punch in shift, then NPV to activate those orange buttons there. So this investment of hers will give a return of 15,621. So it's a positive NPV, meaning that she can be able to invest in it. So the present value of all these cash flows from 30 to 45, discounted back to today at 10%, will be more than this 107,000 by an amount of 15,621. So definitely she can be able to invest because it's giving a positive NPV. Then we come to internal rate of return. So with regards to internal rate of return is defined as is the discount rate that causes the present value of net future cash flows to be equal to the cost of the investment. So essentially speaking is that it is a discount rate that gives you an NPV of 0. So the present value of your cash flows that you're going to generate minus your cost of investment will give you 0. So they'll basically be equal, right? Then to apply that, we are going to look at a question here whereby the same question that we looked at. So Lerato wants to buy a wine making machine of 100,000 and incur 5,000 installation as well as the transport and receive all these cash flows from year 1 to 4. So based on the rate of return of 10%, should she invest in this machine based on internal rate of return, right? So our inputs will be as follows. We'll clear our memory again and punch in 107,000 as our cash flow 0, which is the cost of investment. Then 30,000 cash flow 1, 40,000 cash flow 2, and 42,000 cash flow 3, then 45,000 cash flow 4. Right. Then from there, we then press the shift and activate the orange there with the IRR. So it means there that 16.15% is the required return or cost of capital that will allow the NPV to be 0. So basically, if we invest at 16.15%, the NPV will be 0, right, for this investment. But if you are looking at it in the context of IRR as well, you are also saying that you are getting a return of 16.15%, which is more than your 10%, which is your required return or your cost of capital there. So meaning that you can invest in the project because it's giving you a higher return of 16.15 compared to your cost of capital there, right? So based on IRR, you invest if your IRR is greater than your rate of return or greater than your cost of capital. Then also when you look at it in terms of NPV, we invest whenever our NPV is positive, right? So yeah, so that was it for our session here. So kindly leave comments and questions. We'll be able to answer them in the comment section. And Don't forget to like and subscribe to receive notifications for additional content. Thanks for your time. Take care.